Listen, large caps are really where a lot of people are putting their money still, right? Because this is sort of a lot of comfort there. And we know, listen, they keep moving, you stay with them, you go into them. I'm going to bring a Vetify Investment Strategies, Cinthia Murphy, because Cinthia, you watch this data better than anyone else, right? This is one of the large cap industry ETFs. It kind of speaks for itself, but you say 10 billion went into July alone. How much has gone into this, and what do you account for that? Because people are obviously chasing.
So VOO is your Vanguard S&P 500 fund. It's picked up more than $70 billion in 2025, which is unheard of for any ETF, after already had a record year last year, picking up over $100 billion in assets. So if you think of as your low cost, just own the market S&P 500 ETF of choice for a lot of folks, they're buying it by the billions, which tells you they're positive on the economy. Yeah,
that's what I'm going to say. There's all kinds of ways of measuring the investor sentiment. There's a million of them out there. Wall Street likes them. Isn't this maybe the best way where people are putting their money? I mean, if you keep chasing this, it means at least investors have a tremendous amount of confidence it's going to keep working.
Yeah, and I think what reinforces that concept is that, other funds like SPLG from State Street, which is your low-cost S&P 500, competing with this one, is also picking up like more than $20 billion this year. So you're seeing all these low-cost S&P 500 funds, large-cap U.S. equities picking up assets, and that's retail investors. That's you and me buying. It's not professional traders. Right. So it's a positive indicator.
So you wrote about assessing sectors. And this part, market versus concentration versus concentration maxing. What does that mean to the layman?
You were nerding out. Is if you want to own sectors, which a lot of folks do, only technology, only financials. Financials really big right now. Consumer discretionary. There's different ways to do that with ETFs, which is very cool. So one, you can just own a market cap weighted traditional like S&P 500 does it, like the spider sector ETFs. You can do you don't like concentration risk. You have too much Amazon, too much Nvidia, too much Mag 7. So you can do an equal weighted portfolio where each stock only represents about 5% of a portfolio. That's
sort of like the RSP.
Yeah, like Invesco has a whole series of them, like RSPD, for example, consumer discretionary equal weight. Or a brand new approach that just came out a couple weeks ago, which is from Global X, which I call the concentration maxi, which is they work around the diversification rules and they let the concentration go wherever it is. So, for example, if you look consumer discretionary in each of these three approaches, the spider has Amazon at about 24% of the portfolio, the concentration averse is at 2% of the portfolio, and the maxi has at 31% of the portfolio. So you're getting a lot of different exposure to the exact same basket of names depending on the approach. And so it's something to think about.
I like that. Put me down for the maxi. Put me down for the maxi right now. Okay, there's also this new fund you wrote about, the pure cap. What is that?
Those are the maxis. So they're called the pure cap funds, and they just figure out a really clever way to work around ETF diversification rules that are set by the SEC. And so that you can go with the company whatever market cap it gets to. You don't have to worry about caps on the portfolio.
Now, you also wrote about these money markets and that have come out in the last year. They're starting to gain some popularity. But I'm thinking to myself, isn't that play almost over? And why would I go with a money market fund, ETF rather than just simply buy the money markets?
Well, honestly, Charles, what I find so interesting about this is that we have all this bullish sentiment, all this positive chasing of equities, and you also have record high levels of money parked on the sidelines in market funds, mutual funds, and now ETFs. ETFs are new to the space. They're less than a year old. The S-bill, for example, it's less than 2 weeks old. So people are putting money into that. So you have the super risk on and the super risk off.
Is that the ultimate barbell or the barbell approach now?
It just tells you nobody really knows what to do.
Are they liquid though? Can I get out? Let's say I want to get out tomorrow and move my money into equities.
They're just like any other ETF. So you can trade any time of day, all day long. And that's the beauty of these money market funds. You're picking up 4% yield and you get in and out whenever you feel like it.
Cinthia, thank you very much. I always learn something new from you. Always. Thank you so much.